Get more in the markets this morning. Mohamed El Erian, Allianz chief economic advisor, joins us now. Mohamed, what's your take on the big moves that we've seen in the Treasury market, the big moves that we've seen in the currency markets?
Thank you, Melissa. Look, we are adjusting to the three paradigm changes we've talked about on Squawk: the change in the liquidity paradigm, the change in the growth paradigm, and the change in the globalization paradigm. And that was going to be bumpy, but it offered the prospect of a better destination, a less distorted destination. What is worrisome in the last 24 to 48 hours is two other things: is an accelerated loss of confidence in policy making. You've heard the Fed discussion. If you are here in the UK, there's a lot of concerns about policymakers here. So policy making going from being a repressor of volatility to an amplifier of volatility. And then let's not forget what's happening to flows. Bank of America reported 50 billion went into cash funds out of every single other asset class. So we're starting to see those technical dislocation, and even the Treasury market is not functioning well. So I'm less worried about the first three things, but I'm spending a lot of time on the final two things because they can create very unsettling volatility, not just volatility.
I want to highlight what you said about the Treasury market and your focus on it right now, because the volatility that we've seen, I mean, I haven't seen it before, but you may have seen it before in terms of the huge moves that we're seeing in yields just even intraday. And I'm wondering if you think that there's something that is signaling, because so many people say that there's nothing wrong with the credit markets overall, and that's where they would start being concerned about what the Fed is doing and the impacts.
Yeah, so normally you worry about the peripheral markets, about the high yield market, the leveraged loan market, and you spend very little time worrying about the Treasury market. But there are episodes, and you will remember them: May 2013, again in March 2020, when the problem is the safest market, when the problem is the mother of all markets around the world, which is the Treasury market. And I can tell you, yesterday's price action and what I heard from people trading that market makes you uncomfortable. So keep a really close eye on the functioning of the market, not the yield level, but the functioning of the market.
What does the curve steepening under these circumstances tell you? We were talking to Sri Kumar before, and he said that he believes that the Treasury market, that the yield steepening, the curve steepening, signals that investors are looking forward to beyond the recession to better times, which seems like a very optimistic take, but could very well be true. And I'm wondering what you think it signals, because it seems like there may be certain technical issues that's causing the 10-year yield to go higher and therefore the curve to steepen.
Look, I hope he's right, but it's all about technical issues. A lot of people can't get done what they want to get done. So they're getting done what they can get done. Don't underestimate the amount of suboptimal decisions being made right now because liquidity has become so patchy. So I would be careful extrapolating too much in terms of what does it mean for the economy, because right now technicals are really in control of quite a few curves.
When we see issues in the Treasury market, Mohamed, do we eventually then see the next shoe to drop or the next domino to fall, whatever metaphor you want to use, trouble in the credit markets, trouble in the leveraged loan markets, things like that? Or can it be isolated?
So the Treasury market is the one you cannot isolate. You can isolate other markets, but that's the one you cannot isolate. And it's a reflection of structural weaknesses and fragilities that a lot of people have written about. The G30 has written about. The Treasury itself has been looking into it. So this was long in the making, and it was amplified in a major way by the duration of QE and the size of QE. So these are structural. It matters because, remember, if you can't get what you want to get done, you will start spreading contagion. And that's why it matters for the credit market. You start spreading contagion around markets. So let's keep an eye on it. I'm hoping it will pass. I'm hoping this is just short-term, various things coming together. But of the five factors, this is the one, along with the loss of confidence in policymaking, that I would keep a very close eye on. The other stuff we can navigate, and we understand how to navigate them.
How do you think about equity valuations here with Treasury yields where they are going, where they are right now?
So look, I think there's value. There's some very attractive single names, but you just can't avoid the macro factor right now. I was asked, if you have had a lot of cash on the sideline like I have, because I've been worried. In fact, I have a bet with Joe, and I'm sorry he's not on today, because I was going to offer him the possibility to buy back his bet. I have a bet with Joe about where we're going to get to on the S&P, and I had said 3,600 before we get to 4,400, and I think unfortunately that is likely. So I wouldn't go in single names right now because they are being impacted in a major way by what's happening market wide, but there are significant value being created.